Well, as Tom mentioned, the venerable old publishing house, Fairfax Media, has had better weeks. Even before the nasty profit warning and the decision to gain altitude by throwing sub-editors out of the plane, the share price did start to tumble on the back of a detailed and influential piece of research highlighting the dire situation that Fairfax finds itself in. I spoke to the author of the report, Deutsche Bank's media analyst, Andrew Anagnostellis. Well, Andrew, every time you look at Fairfax, you seem to cut the target price. Last week was $1.40, started this week down to $1.20, after their announcements down to $1.10 with a sell. So how sure are you about the $1.10?
Yes, well, the reality is until we see a stabilisation in the revenue decline, we can't really be sure. Clearly, there's a lot of challenges out there. There's also the soft commercial consumer economy. So until we get visibility on earnings and the stabilisation in revenues, really we can't be that sure. If you look back to the pre-GFC levels in 2008, from that time till 2011, we estimate revenues will have fallen by around 13%. That is excluding the impact of the global financial crisis.
The peak operating profit at the time of those revenues was about $800 million EBITDA. Do you think they can ever get it back to that level?
We think it's very difficult to see those levels being achieved. One of the main reasons is the decline in classified revenues, particularly in employment, but also in the other categories. We think it's very difficult to see those revenues coming back. A lot of that revenue has gone to the online platforms, realestate.com, car sales and Seek. In that environment, on the online space, it becomes a winner-takes-all. In that environment, it's very difficult to recapture lost share.
Now, in your big report at the start of the week, you made the interesting point that they have to choose between investing for growth or managing the business for profit and cash. And you said that really they ought to do the latter. It just seems to me that they've been talking about investing for growth, but in their announcements this week indicated that really what they're going to do is manage the business for cash. Is that how you see it?
Yes, I think the reality is that they don't have a lot of choices. If you talk about growth options, as you know, they made major acquisitions a number of years ago. The Rural Press one in particular was a good, sensible acquisition. Since then, it's been very difficult to find suitable acquisitions. And part of the reason is that on the online space, the really good online platforms are really very well established and by now very expensive. We think the best bet now is to really stabilise the cost platform given the very sharp decline in revenues.
Do you have a specific view about the decision this week to outsource the sub-editing and sack a lot of the sub-editors? Do you think that's a good idea or a necessary idea?
I certainly think it's a necessary idea. What we advocate and what we expect over the next few years is a lot more of those type of initiatives. That is just one of them. The other one which has been actively talked about is sharing of print and distribution with News Corporation, particularly in Sydney and Melbourne. That to us would make a lot of sense, would save money. The trick with all these things, of course, is how do you cut costs without affecting the quality of your product? And that is, of course, the challenge. If you cut costs too aggressively, as we've seen in some of the overseas markets, the quality of your product does start to suffer.
In fact, do you think that what you're suggesting, that is cutting costs and managing for cash, is in fact managing the company for decline?
I think I would categorise it as reflecting the realities of the current situation. What you're confronted with is revenue declines, circulation falling, not enough online presence to offset that, and at the moment, a soft economy.
Do you think the newspapers have a future at all?
I certainly think the provision of news to consumers has a future. I just think newspapers will look very different in a number of years' time, and we're seeing